Happy morning, guys. Moving on to the next chapter in financial management, that is ratio analysis. Chapter number 3, that is ratio analysis. So, we have already completed working capital management, all 3 units. Now, next chapter, that is ratio analysis. So, what is this ratio analysis? See, ratio analysis is basically comparison of two variables. Like if it is gross profit ratio, you are going to compare two variables, that is gross profit and sales. So, a basic terminology for this ratio analysis is you are going to compare two variables in order to express one variable on the terms of other variable. That is, the definition which they have given is ratio refers to one variable expressed in terms of another variable. That is, one variable, gross profit is being expressed in terms of sales. Then it is called gross profit ratio. It explains the interrelation between two variables. So in ratio analysis, we can formulate ratios based on four elements. That is, one is time element. The other one is like time element in times, in proportion, and in percentage. So basically, what is this in times? Times basically refers to current ratio. All those liquidity ratios are dumped into this times. Current ratio, liquid ratio, and quick assets ratio, quick liquid ratio. All these terms are being dumped under this times. It will be expressed as times. And next is time element. And time element is this short-term solvency ratios, proportion, all these coverage ratios, and in percentages, all this gross profit, net profit ratios, all those profitability ratios are expressed in terms of percentage. So these are the four types of different categories of ratios. In each four category, we have different ratios which we are going to work in this particular chapter, that is ratio analysis. So we'll have a small discussion on theory side of this ratio analysis to have a clarity over these formulas. Then we'll move on to the problems. Only when you do the problems, you will understand all the different terms of these ratios. Whereas in this theory part, we'll just have a clarity over this different formulas. So the following are the steps involved in analysis through accounting ratios. Collection of raw data from the financial statement for computing different ratios. So for computing all these different ratios, the basic requirement is you need all the raw data from financial statements. That is, you need income statement, which is profit and loss account. You need balance sheet, that is financial position statement. Both these statements are prerequisite in order to calculate different ratios. See, suppose if they have asked you profitability ratios, then you need this income statement in order to see what is gross profit, what is sales, what is net profit. So collection of this raw data is the prerequisite. And next is computation of ratio between the numbers having cause and effect relationship. See, gross profit has a relationship, interrelationship with sales. So we are calculating gross profit ratio. So we should calculate ratios based on this interrelationship and compare the current ratio with the ratios of previous period. See, actually why these ratios are being calculated. The ratios are being calculated for two, see, point number one, ratios are being calculated in order to compare present data with the previous data of the own company. That is, suppose you own a company, you are calculating ratios each year in order to compare your performance with the past year. That is, in order to compare your profitability, suppose profitability ratios are calculated in order to compare your present year performance with the previous year performance. On the other side, you can, if suppose you are a fresh company, like you are a new entrant and you have been producing a particular product, and for a year you have calculated ratios. So you can't compare with the previous year ratios because you have started your company in the present year. So in this situation, you can compare your ratios. That is, you can compare your performance based on the ratios with the industry average ratios. So these are the two different functions, two different possibilities of calculating, comparing the performance of the business. That is, either you can compare with the previous year performance or you can compare with the industry average performance. So this is the comparison which can be done using these ratios. And next is, in the final step, necessary reports are to be prepared for communicating analyzed information along with the relevant commands to the management. That is, based on these ratios. See, in this CMA Inter, you will be only calculating what is the ratios. That is, if they ask you profitability ratios, you will calculate all the gross profit, net profit, then operating profit ratios, all these different ratios. If they are asking you coverage ratios, you will be calculating interest coverage ratio, EBIT, different ratios. Whereas if they have asked you turnover ratios, asset turnover, creditors turnover, debtors turnover, all these are different ratios which you will be calculating in Inter. Whereas in CMA final, based on these ratios, you have to compare with either previous year or you have to compare with the industry average, and you should comment on that ratios. That is, in Inter, you will be only calculating the values, that is ratios. Whereas in final, you will be giving comment on that performance of the company using the ratios. So the final steps in point number D, they have given like clarity over this necessary reports. That is, these necessary reports will be given only in final. So they have mentioned final step. So in CMA final only you will be giving this necessary reports. Whereas in this Inter only you will be calculating what are the different ratios and what are the different advantages of ratio analysis. You can by calculating the liquidity ratios like current ratio, liquid ratio, quick assets ratio, all these are different ratios which you will be calculating in order to find the liquidity portion of the company. What is meant by liquidity portion? Liquidity portion is immediate availability. Like if suppose you want immediate cash, so what is your liquid position? How much you can immediately convert into cash? How much is immediately available in cash? All these are different values which you can find using this liquidity ratios. So based on this ratio analysis, that is liquidity ratios, you can find the liquidity portion of your company. And next is operating efficiency. Ratio analysis facilitates to know the efficiency of the management and utilize its assets. Operating efficiency, that is using asset turnover ratios, you can find what is the efficiency of your business and overall profitability. Using this profitability ratios like GP ratio, that is gross profit ratio, net profit ratio, operating profit ratio, you can find the profitability portion of the company. And interfirm comparison. Interfirm comparison is nothing but you can compare your company results, that is your company ratios, with the other company ratios in order to find the efficiency of your business. That is, interfirm means comparing with the other firms, comparing your firm ratios with the other firm ratios. And measurement of solvency. Solvency is nothing but, see, what is solvency? Solvency is the capital structure. See, like if suppose your company has 70% debt and 30% equity, so your company is relying more on debt. That is, you are going to pay a large amount of profit as interest. So using these ratios, you can calculate the measurement. That is, you can find your solvency position. That is, how much is your long-term debt, how much is your short-term debt. All these can be measured using this solvency ratios. And next is facilitates planning and forecasting. That is, this ratio analysis basically helps in planning for the future. That is, suppose your present ratios has been calculated. Using those present ratios, you can comment on those ratios. That is, you can prepare a report which will be helpful for the future endeavors of the firm. And next is, the organizational and departmental efficiency are evaluated through this ratio analysis. You can even do intra-firm analysis. That is, different departments ratios can be compared in order to find the efficiency of the departments. Then it facilitates controlling different costs, identifying various areas which requires exercise of control by management. That is, if suppose your gross profit is more, whereas your net profit is less, then you are expending some non-profit expenses, non-operating expenses, which is uh, on which you should have a control. So using this ratio analysis, you can find that where you can have control over the expenses. So ratio analysis is well accepted by outside parties for various purposes. Example, financial institution, investors, creditors, government tax authorities. All these people will have uh, knowledge over the ratios of the particular business before they are coming into the business. That is, before, suppose financial institution, what they need. Financial institution basically need how the company is performing. So it requires all the solvency ratios and it requires the profitability ratios so that it can give loan. So based on this solvency and profitability ratios, financial institution will give loan. And investors basically come in by seeing the solvency ratios, and creditors basically come into the firm. That is, creditors will give credit, that is supplies to the to a particular company by seeing the credit turnover ratio. So that is creditors turnover ratio. So government tax authorities will also see the ratio analysis by for uh, seeing the amount payable. That is, by seeing the profitability ratios, government tax authorities will calculate the income tax which is payable. So all this different types of financial institutions, investors, creditors, government tax authorities, all these people will see the ratios of the particular firm. And what are the different limitations of ratio analysis? Wherever there is a positivity, there will definitely be a negativity. So what are the different limitations? One, window dressing. That is, ratio forecasting the picture of performance at a particular point of time. Sometimes a business can make year-end adjustments in order to result in order, that is not in order to result in favorable ratios. That is, I'll give you a quick example. What is this example is, what small scale, that is MSMEs, medium, small and micro enterprises do in order to boost their sales. That is, in order to use the black money, what they'll do is, in the beginning of the year, they will bring the amount, that is black money, or they'll bring in the all those unshown income, like basically, what is this un, income which has no source, income which has not been disclosed to government. Those incomes, those amount, it will be taken into a particular small scale concern in the beginning of the financial year, and during the end of the financial, that is January or February, it will again be taken out, so that it cannot be disclosed in the, so that they don't want to disclose it in the financial statements. So what they'll do is, they'll bring those amount as advance, that is advance given by suppliers or advance given by the customers, and in the year end they will take it out by return to the customers. That is, advance which has been paid by the customers will be returned to the customers. This way, small scale concerns, that is small businesses, will manipulate in their financial statements. With this, what will happen is, when in the year end, when you are calculating ratios from the financial statements, you will have favorable ratios, because your debts will be low, because you are bringing in the amount which is not been disclosed in the financial statements during the year end. So your debt to total fund will be low, so that it is a favorable position for the company. So this is called window dressing. And next is impact of inflation. Financial statements and ratios are affected inflation. That is, suppose there is an inflation. Okay, there is an inflation in a particular point of time. It is not affected by, it is not affecting the financial statements. That is, assets are being recorded at the price historical cost, so it is not being recorded in the market cost, so that this inflation is being removed. So financial statements and ratios are not affected, that is are affected, they are given are affected, but what you should mention is are not affected by inflation. Next is product line diversification, that is detailed ratios different divisions, products, and market segments, etc., may not be available to the users in order to make informed judgment. See, ratios basically companies. What these companies will do is they will prepare ratios a company as a whole. They won't prepare for each product. So it will affect the judgmental. That is, it will affect the customers or all those different financial institutions, government tax authorities, investors, creditors, all those people judgments. That is, they can't make proper judgment with the ratios which is being provided for industry as a whole, and difference in accounting policies. This will majorly affect the ratios. That is, it will limit the ratio analysis calculations. Different may follow different like on different companies will follow different accounting policies, which will lead to mislead of comparing results. That is, suppose there is a company X and company Y. If company X is following FIFO, like suppose if company X is following FIFO method and company Y is following LIFO method, the stock turnover ratio of two companies will definitely be different, which will not be a right thing to compare. Or the stock turnover ratios of X company and Y company cannot be compared because they follow different accounting policies. So for another example is providing depreciation under straight line method and written down value method. When you are providing under straight line method, there will be fixed depreciation for every year, whereas under written down value method, fixed percentage of depreciation. So this will affect the comparison of fixed asset turnover ratio. The next is interdependence. Financial ratios cannot be considered as absolute. The decision taken on basis of one ratio may be incorrect when a set of ratios are analyzed. That is, what are the different financial ratios? All this debt to total fund, all these coverage ratios are part of financial ratio. So you can't make judgment with only one ratio. You should have analysis over all the ratios, because all the financial ratios are interdependent. So they have separately explained what is this window dressing. You just go through it. And coming to the next, what are the different types of ratios? There are 6 types of ratios: liquidity ratios, capital structure ratios, profitability ratios, coverage ratios, turnover ratios, and overall return ratios. So we'll see what are these different types of ratios and what are different ratios in this different categories, and then we will move on to problematics. So first we'll see the liquid ratios. Current ratio. So what is this current liquid ratio? First we will see what is liquid ratio, then we will move on to liquid ratio measures the entity's ability to meet its short-term obligations. That is, see, liquidity. Liquid means what is easily convertible into cash. That is called liquid. So this liquidity ratios will measure the entity's ability to meet its short-term obligations. That is, suppose you want to expend on, you have a commitment to settle debtors. That is, you settle creditors on first of every month. You should pay 1/5 of creditors. That is, whatever the balance that is there in the creditors, 1/5 of that you should pay every month on first. So this liquidity ratios enables you to measure what is your ability to meet its short-term obligations. All those payment to creditors, all those outstanding expenses, wages, salaries, all these are short-term obligations, and your ability to meet these short-term obligations can be calculated using this liquid ratios. So what is this current ratio? Current ratio means current assets divided by current liabilities. Simple. Current ratio, first formula. Current ratio means current assets divided by current liabilities. What are different current assets? Current assets includes all the assets which are convertible into cash within period of 12 months. Okay. In balance sheet, on the asset side, what are all the assets which are convertible into cash within period of 12 months? Then all these are current assets. So what are the different current assets? Debtors, bills receivable, bank balance, short-term advances, inventory. Inventory is nothing but stock, and stock is of three types: stock of raw material, stock of work in progress, and stock of finished goods. And next is outstanding revenue, whatever the outstanding balance which is receivable, and expenses paid in advance. See, any advance that expenses which has been paid in advance, it will fall under current assets. A good example is selling and distribution expenses which has been paid in advance will fall under current assets. We saw that in a working capital management in one sum, that advance of selling and distribution expenses has been paid, then it will fall under current assets. Any expenses which has been paid in advance will fall under current assets. The next is short term investments. Any investments made for short term within period of 12 months, then it is current assets. Then marketable securities. Marketable securities is nothing but any securities which is easily convertible into cash. All those bonds which are marketable securities will fall under current assets. And on the other side, what is current liabilities? Current liabilities is nothing but a liability which fall due for payment within 12 months. Suppose creditors, if you are paying it within 12 months, then it will fall under current assets. Or else if a particular amount which has been taken on credit is payable after 3 years, then it is a classified as loan, that is long term loan. So creditors, then outstanding expenses, short term loans, bank OD. Bank OD is nothing but when there is a outstanding overdraft balance with the bank, then it is called bank overdraft. And cash credit. Cash credit is nothing but you will be receiving cash on a credit from a creditors. That is, you will be see, cash credit is nothing but a cash credit which has been received in order to meet your short-term obligation, which you will repay within shorter period. That is called cash credit. And provision for taxation will also fall under current liabilities. Suppose you are keeping a certain part of your profit as provision for taxation, then it is also a payment which you are going to make within period of 12 months. Then it is current liabilities. Then next is proposed dividend. Proposed dividend will fall under current liabilities. And unclaimed dividend. Unclaimed dividend is nothing but a dividend which has been proposed, which has not been issued, which has not been claimed by the shareholders yet. That is unclaimed dividend. So all these are current liabilities. So current assets is nothing but current ratio is nothing but current assets divided by current liabilities. And basically all these liquid ratios are expressed in terms of times. And this is very important point, that is the ideal current ratio is 2.1. Suppose you have been given a sum, you have been given a problem in examination, and they are asking you check whether ratios are ideal. So ideal current ratio is 2:1. If suppose a company X has a current ratio of 1.5:1, then that company X is not liquid, like it is not having a good liquidity position. If suppose your current ratio of a particular company is 2.5:1, then that company is having a good liquidity position. If suppose it is below 2:1, then it is, if suppose company X is having 1.5:1, then that particular company is not having a favorable liquidity position. You should use this word favorable. If suppose current ratio is more than 2:1, that is 2.5:1 or 3:1, it is favorable liquid position. Whereas if it is less than 2:1, it is unfavorable liquidity position, or it is not a favorable liquidity position. So that is current ratio. And next is liquid ratio, quick ratio. Quick ratio can be also called as liquid ratio. Quick ratio can also be called as liquid ratio. So quick ratio is nothing but quick assets divided by quick liabilities, or liquid assets divided by liquid liabilities. So what is this quick assets? Quick assets is nothing but current assets minus inventory minus prepaid expenses. Why these inventories and prepaid expenses are removed? because this quick assets measures the ability of the entity to meet its immediate liabilities. Quick ratio will always focus on how your immediate liabilities, that is quick liabilities, can be paid. You cannot pay your liabilities using your inventories, because inventory is your stock. The stock should be sold in the market so that that cash can be paid to the for purpose of liabilities. If you have your quick liabilities, suppose you have to pay your creditors, you cannot pay your creditors with your stock, you can only pay with your cash. So inventories should be sold in the market so that it can be the company can receive cash and pay the creditors. So it is not a quick asset. On the other hand, prepaid expenses, any prepaid expenses cannot be used for the purpose of making payment to the quick liabilities. So these two are removed from the current assets for purpose of quick assets. So just remember this formula. Don't go into research and all. Quick assets means current assets minus stock minus prepaid expenses. Simple. Quick assets is equal to current assets minus inventories minus prepaid expenses. That's all. Current assets minus stock minus prepaid expenses. That is called quick assets. And what is quick liabilities? Quick liabilities is nothing but current liabilities minus bank OD minus cash credit. So current liabilities minus bank overdraft minus cash credit is the quick liabilities, and current assets minus stock minus prepaid expenses is the quick assets. So basically this quick ratio is equal to quick assets divided by quick liabilities. And for current ratio, the ideal ratio is 2:1, and for quick ratio, the ideal ratio is 1:1. So if you have a small like, you can use your notes also to record it. Just write down the formula name, that is current ratio is equal to current assets divided by current liabilities. And yeah, next to that, within bracket, just write down the ideal ratio, that is 2:1. Below that, quick ratio is equal to quick assets divided by quick liabilities. Within bracket, 1:1. So if a particular company has a quick ratio below 1:1, that is if it is having 0.75:1, then it is not having a favorable quick assets favorable liquidity position. Whereas if it is having more than 1:1, then it is having favorable position. So next is absolute quick ratio. So absolute quick ratio is nothing but it measures the availability of cash and cash equivalents to meet its short-term commitments. Okay, quick assets is nothing but any asset which is easily convertible into cash and which can be converted into cash immediately. That is called quick assets. Whereas absolute quick assets, for absolute quick ratio purpose, only cash and marketable securities is immediate cash. If suppose next minute if you want to pay a particular liability, current liability, you can pay it using either cash or your marketable securities. So these both are absolute quick assets. So if they ask you absolute quick ratio, what is the formula is absolute quick ratio is equal to cash plus marketable securities divided by current liabilities. You have to divide it by current liabilities only. You should not use quick liabilities. For purpose of absolute quick ratio, formula is cash plus marketable securities divided by current liabilities. Okay. So there is no ideal ratio given for this absolute quick ratio. For current ratio, it is 2:1. For quick ratio, it is 1:1. So absolute quick ratio is current cash plus marketable securities divided by current liabilities. And next is cash interval measure. See, cash interval measure is nothing but how much cash you are available. That is, how much is cash available with you in order to meet regular cash expenses. Okay, it measures your ability to meet the regular cash expenses. Suppose you have a regular cash expenses. Suppose you are a contractor. Okay, you are a engineer. You are a supervisor engineer something, and you are making payments to all the mason, all the bar benders who is working in the sites. So if you are a contractor, you are going to make payments on every Saturday. So using this cash interval measure, you can measure the ability of you to make the cash expenses every Saturday. So that is the cash interval measure. Using this particular ratio, you can measure your ability to meet the regular cash expenses. What are the different wages paid to the bar benders, all the masons on the on every Saturday. So you can measure this using this cash interval measure ratio. So how can you measure this? You can easily measure this using cash interval formula, that is quick assets divided by cash expenses per day. You can even measure it per week, but per day is the formula which has been provided. So quick assets divided by cash expenses per day. How can you find this cash expenses per day? It is nothing but total cash expenses in a particular year divided by 365 days. You will get cash expenses per day. So using this, you can find the cash interval. Quick assets divided by cash expenses per day. That is called cash interval measure. Okay, fine. So you have understood what is liquidity ratios. So if suppose they in exam they will ask you, they'll give you for this liquidity ratio, liquidity ratios, you need balance sheet because current assets, current liabilities, everything will be available in the balance sheet. So how they will ask you the question is, they'll give the balance sheet. They in the below they will ask you to find the liquidity portion of the company, or they'll ask you to find the liquidity ratios. So when they ask you to find liquidity ratios, you have to calculate these four ratios, that is current ratio, liquid ratio, or quick ratio, and absolute quick ratio, and cash interval measure. So these four are liquidity ratios. And next is capital structure ratios. Very important formulas, that is very important ratios, which is repeated in the examination. This capital structure ratios. What are the different capital structure ratios? So what is capital structure? Capital structure is nothing but on the liability side of the balance sheet, in the top three will be the capital structure. That is, what is your equity, what is your preference share capital, what is your reserves and surplus, what is your debentures, what is your long-term loans, and what is your long-term loans from financial institution. That is, long-term loans from bank and long-term loan from financial institution. These are the different long-term loans. So all these put together is the capital structure. Okay. In simple words, all the funds which are made available is called capital structure. Suppose you have 10 lakhs as your capital. So how this 10 lakh has been procured? You will be procuring it using equity share capital, using preference share capital. Some will be the profits of the company, some will be the debentures issued, and some will be taken as loan from banks, financial institutions. So all this put together is the capital. So this capital structure, using this capital structure, all the ratios can be analyzed. So you have nearly four to five ratios in this capital structure ratios. So what are the different ratios? First is debt to total fund ratios. So debt to total fund ratio can be calculated by using debt divided by total funds. So what is basically debt? Debt is nothing but debentures and long-term loans which has been procured by the company. So that is called debt. It is borrowed fund. Debt is nothing but borrowed fund. Debentures and long-term loans put together is called debt. And equity. What is equity? It refers to shareholders' funds or the net worth which consists of the following. Equity is nothing but equity share capital, preference share capital, reserves and surplus, miscellaneous expenses, and accumulated losses. All these put together are equity. So debt is debentures plus long-term loans. Equity is equity share capital, preference share capital, reserves and surplus, and you should deduct the miscellaneous expenses from that so that you will get equity. So both these put together is the total fund. Okay. Debt is debentures, long-term loans. Equity is equity share capital, preference share capital plus reserves and surplus minus miscellaneous expenses. So both this debt and equity put together total funds. So for debt to total fund ratio, you can calculate it using debt divided by total funds. So next is equity to total fund ratio. This equity to total fund ratio can be calculated by equity divided by total funds. In the above formula, we calculated what is debt, what is equity, and what is total funds. So based on these three, you can calculate debt to total fund, equity to total fund, and debt to equity. So next formula, simple. Debt to equity means you should calculate by debt divided by equity. So this debt, what is this debt part, and what is this equity part, and what is this total fund part? You should calculate all these three in order to find these three formulas. That is debt to total fund ratios, equity to total fund ratios, and debt to equity ratios. So you should, before this, you should have what is this debt to equity. Debt is nothing but all the borrowed funds, and equity is nothing but ownership structure. That is, if suppose a company is issuing equity shares, then they are the owners of the company. So equity is nothing but a part of a capital structure which Who owns the company? All the shareholders, preference shareholders, all the profits of the company, all these are put together is equity. Whereas debentures, debt is nothing but all the borrowed funds of the company. So that is called debt and equity. And next is capital gearing ratio. This ratio explains the proportion of fixed charge capital to the equity fund. That is, see, for certain portion of your capital, you will be paying fixed interest. That is, for debentures, you will be paying fixed interest, that 15% debentures, 12% debentures. For those people, you will be paying that percentage as interest. And for preference share capital also, whether you are making profit or loss, you will be paying fixed interest. That is 12% preference share capital, 5% preference share capital. So for this preference share capital, for this debentures, you will be paying fixed charge on the capital. Whereas for equity shareholders, you won't be paying any fixed charge. Whereas whatever the profits a company is making, after making this fixed charge on capital, whatever the remaining portion is left will be distributed to the equity share capital. So based on this concept, you will be calculating what is capital gearing ratio. So what is capital gearing ratio? Preference capital plus debt, which is a fixed charge capital. Preference share capital and debt, you will be paying fixed charge. So in the numerator, preference capital and the debt divided by equity shareholders funds. For equity shareholders fund, you will be paying only, you will be paying whatever the leftover profit. You will not be paying any fixed charge. So this capital, whenever they ask you capital gearing ratio, just remember this one point. In the numerator, fixed charge. In the denominator, leftover charge. That is, in numerator, for whoever you are paying fixed charge on capital, those people will come into numerator. Preference capital debt. In denominator, the remaining capital will come in the equity shareholders funds. So capital gearing ratio is equal to preference share capital plus debt divided by equity shareholders fund. So equity shareholders fund is very simple. Equity minus preference share capital. You will get equity shareholders fund. And proprietary ratio. Proprietary ratio refers to equity. That is, proprietary fund divided by total assets. What is this proprietary fund? Is equity. How much is your equity when compared with total assets? That is being calculated by proprietary ratio. So when they ask you proprietary ratio, just remember proprietary fund divided by total assets. When they ask you capital gearing ratio, fixed charge capital divided by leftover capital, equity capital. That is, fixed charge capital means preference share capital plus debentures divided by equity shareholders funds. So last one is fixed assets to total term fund ratios. Not total, it's long term fund ratio. What is this long term fund? Long term fund includes all the funds which are being procured for more than 12 months period. That is, current liabilities won't come into picture. So fixed assets to long term fund ratio can be calculated by net fixed assets divided by long term funds. You have to calculate it using net fixed assets divided by long term funds. So that is called fixed assets to long term funds ratio. So there are 6 ratios. One is, so when they ask you to find capital structure ratios, after giving a balance sheet, if they ask you to find capital structure ratios, then you have to find the 6 ratios. Debt to total fund. Debt divided by debt plus equity. Then next is equity to total fund. Equity divided by debt plus equity. Then debt to equity ratio. Debt divided by equity ratio. Then capital gearing ratio. All the fixed charge capital, that is preference share capital plus debt divided by equity shareholders funds. What is this equity shareholders funds? Equity minus preference share capital, that is equity shareholders funds. And next is proprietary ratio. Proprietary ratio is nothing but proprietary fund divided by total assets. Proprietary fund is equity and divided by total assets. And next is fixed assets to long term funds ratios. This can be calculated using net fixed assets divided by long term funds. You have to remember all these formulas. Suppose if they ask you capital structure, see, few times they might give the ratios name itself, like calculate current ratio, liquid ratio, quick assets ratio, absolute quick ratio, all those things. Or if it is capital structure ratio, sometimes they'll give calculate debt to equity ratio, debt to total fund ratio, capital gearing ratio. Sometimes they'll give like this. But few times what they'll do is after giving a balance sheet, they'll just find out liquidity positions and capital structure ratios. If they give like this, you should only remember the formulas. You should only remember the different ratios which should be found in capital structure ratios. So next is profitability ratios. Very easy. You would have read this in PU itself. That is gross profit ratio, operating profit ratio, net profit ratio, contributions to sales ratio. That is profit volume ratio. Contribution divided by sales into 100. What is contribution? Contribution can be calculated in two ways. One is sales minus variable cost. That is contribution. Or fixed assets plus profit. That is also a contribution. If you come from top to bottom, it will be like sales minus variable cost. You will get contribution. If you go from bottom to top, that is profit plus fixed cost, that is contribution. So that is called profit volume ratio. So we'll have small discussion over this. What is gross profit ratio? That is gross profit divided by net sales into 100. So what is gross profit? Gross profit as per trading account. See, in trading and profit and loss account, whatever the profit which you got in trading account, it is gross profit. And after deducting all the expenses, that is non-operating expenses, all the expenses made by the company, then you will get net profit ratios. So okay, gross profit ratio is now gross profit divided by net sales into 100. And operating profit ratio. Operating profit ratio is nothing but operating profit divided by net sales into 100. What is this operating profit? There is a slight difference between net profit and the operating profit. In order to calculate operating profit, what you should do is first write net profit, calculate net profit as per P&L account. On that, add all the non-operating expenses and deduct all the non-operating incomes. You will get operating profit. Net profit as per P&L account, add all the non-operating expenses and deduct non-operating incomes. You will get operating profit. What is this non-operating? Non-operating is nothing but expenses or income which is not relatable to the business. So that is called non-operating expenses or non-operating incomes. Suppose loss on sale of assets. Is it, suppose you are doing, if you are doing if you are doing real estate business, then this loss on sale of assets is an operating expense. Whereas if you are doing if you are having academy, suppose if you are doing this teaching profession, if you are having a academy, then this loss on sale of assets, if you are selling all your particular asset, then this loss on sale of asset is not relatable to operating side of business. So this falls under non-operating expenses. This loss on sale of assets should be added back to the net profit in order to calculate the operating profit. So with expenses or income which are not relatable to the business, which are not relatable to the operating side of the business, then it should be added. The expenses should be added and income should be deducted in order to calculate operating profit. And net profit ratio is nothing but net profit divided by sales into 100. And contribution ratio I already explained. That is contribution divided by sales into 100. So that is profitability ratios. And next is coverage ratio. Coverage ratio, see, it is very small concept, but this coverage ratio, maximum number of times they have asked in exams. So this coverage ratio, you will not only study here, you will learn it in leverage analysis, another chapter also, that is leverage analysis. So what is this coverage ratio? There are three types of coverage ratio. That is interest coverage ratio, debt service coverage ratio, and preference dividend coverage ratio. Coverage ratio is nothing but for making a particular payment. That is, if you are making a particular interest for debt, that is, you have taken 12% debentures, and for the 12% debentures of 1 lakh rupees, you are paying 12,000 rupees as debentures every year. So for making this 12,000 rupees, how much is your coverage? That is, to make it simple, see, suppose your total profit is 1 lakh rupees. No, 50,000 rupees. Okay, your total profit in a particular year is 50,000 rupees, and you have taken 1 lakh rupees on debentures for 12% debentures. So how much you are paying? 12,000 rupees. So for making this 12,000 payment, the debt holders, that is the person who is purchasing the debentures of your company, will see how many number of times you are making profit compared to my interest amount which you are paying. That is, suppose for debentures you are making 12,000 payment, okay, as interest. If suppose your profit is 48,000, so you are making 4 times of profit compared to my debentures, compared to my interest payment. So that is called coverage ratio. Whatever the interest you are going to pay as debentures, you should compare it with the amount which is left over in order to make that interest payment. Suppose for me, after leaving all the expenses, that is after deducting all the expenses, the profit left over is 48,000, and the next is I should make interest payment for debentures. Suppose I'm making 12,000 interest payment. So for making 12,000 interest payment, I'm having 48,000. That is only called coverage ratio. For this, that is called interest coverage ratio itself. So 48,000 is available before making interest payment. So 40,000 divided by 12,000. So you have 4 times coverage. That is, your interest payment is covered 4 times. That is called coverage ratio. That's all. So interest coverage ratio, it indicates the ability of the entity to meet its interest obligation of the current year. The ideal interest coverage ratio should be always greater than 1. As per our example, it is 4, but ideal interest coverage ratio should always be 1. What is this interest coverage ratio? Formula: EBIT. EBIT is nothing but after deducting all the expenses from the profit, you will get EBIT. After calculating EBIT, what payment you will make? Interest. So that you will get EBT. So before making interest payment, what is the profit available? EBIT. So after EBIT, you will deduct the interest. Then you will calculate EBT. Normally, we didn't study that chapter still. Yeah. See, in leverage analysis, what is the structure of calculating profit after tax is sales minus variable cost. You will get contribution minus fixed cost. You will get profit. From that profit, if you deduct non-operating expenses, you will get net profit. Net profit is nothing but earnings before interest and tax. Okay. From that EBIT, the next amount which you are going to deduct is interest. Then you will get EBT. Next amount you are going to deduct is tax. Then you will get profit after tax. If it is divided by shareholders, number of shares in the company that is issued by the company, you will get earnings per share. This is the structure of calculating the EPS. So EBIT, after calculating EBIT, the next amount which you will be deducting is interest amount that has been paid to the debentures. So for calculating this interest coverage ratio, the formula is EBIT divided by interest. So you will get how many number of times your interest has been covered. That is interest coverage ratio. And next is debt service coverage ratio. Debt service coverage ratio is nothing but the extent of current earnings available for meeting the commitment of interest and installments. Okay, that is, suppose you are having earnings of 1 lakh rupees and you are going to make payment of interest, and you are going to make payment of preference capital. That is, what are all the different interest and installments which you are going to make? Simple, you are going to make a payment of 50,000 as principal installment. So that also should be added to the interest because you are making it using your profits. So simple. The formula for this debt service coverage ratio is profit after tax plus 1 minus tax rate. That is, profit after tax plus interest into 1 minus tax rate. On interest, you will get some advantage. That is, on interest, you won't be paying any tax. Suppose if you have 1 lakh rupees of profit, first you will make interest payment. Then you will get what is the profit left over. On that only you are going to pay tax. So the tax amount on the tax percentage of this on this interest payment, you are going to get as advantage when you are procuring debentures instead of equities. That is, you are not going to make any tax on interest. So the formula for this debt service coverage ratio is profit after tax plus 1 interest into 1 minus tax rate. That is the total profit available in order to make payment for interest and principal. So profit after tax plus 1 minus interest into 1 minus tax rate divided by interest plus principal. So this is the debt service coverage ratio. An ideal ratio must be 2 to 3 times. So earnings for debt service can be calculated as shown below. Net profit after taxation, add interest on debt funds, add non-cash operating expenses like depreciation, add non-operating items, that is called earnings for debt service. So next is preference dividend coverage ratio. Simple, preference dividend coverage ratio is paid, basically preference dividend is paid after calculating the profit after tax, that is earnings after tax. Earnings after tax and profit tax are same. Okay, after calculating EBIT, you will deduct the interest, you will get EBT. After, that is earnings before tax. On that you will deduct tax, you will get PAT, that is profit after tax, or earnings after tax. After calculating the earnings after tax, then only you will make payment for preference dividend. Then from that you will, after that you will make payment to the equity dividend. So preference dividend is paid out using earnings after tax or profit after tax. So the formula for this preference dividend coverage ratio is earnings after tax divided by preference dividend. Earnings after tax divided by preference dividend, that is preference dividend is always paid from the available earning after tax. That is, after earnings after tax, whatever the amount left over in the earnings after tax, from that you will make preference dividend, payment for preference dividend. After making payment for preference dividend, whatever the earnings available for shareholders, on that you will make dividend payment, that is equity dividend. So these are the different coverage ratios. Interest coverage ratio and preference dividend coverage ratio are two important ratios. And the next one is, that is turnover ratios. So what is this turnover ratio? Turnover ratio is like analysis of performance. So in this turnover ratio, you will find what is the performance of the particular department. That is, if suppose raw material, how better the raw material has been used, how effectively the raw material has been used, that is calculated in the raw material turnover ratio. So simple, wait, how to explain this raw material turnover ratio is, the better way to understand raw material turnover ratio is, it is an activity ratio of performing a particular activity. Suppose you are purchasing a raw material, okay, within which time you are using that raw material is calculated in the raw material turnover ratio. That is, in a particular year, that is for a particular year, 1 year, how many times you are reusing, like suppose your average stock of raw material is 50,000 and stock of raw material consumed is 50 lakhs. So 100 times your raw material ratio is 100 times, so that you are repurchasing your raw material 100 times. That is, the higher the amount is, the higher the efficiency of raw material turnover. So simple, raw material turnover ratio. First we will start off with the raw material turnover ratio. Okay, raw material turnover ratio is nothing but cost of raw material consumed divided by average stock of raw material. What is cost of raw material consumed? Opening stock plus purchases minus closing stock, that is cost of raw material consumed. And average raw material, average stock of raw material is nothing but opening stock of raw material plus closing stock of raw material divided by 2. If you compare this, that is if you divide this both, you will get raw material ratio. So higher the raw material ratio, higher the favorable position. So that is raw material turnover ratio. And a work in progress, all the formulas are same. Work in progress turnover ratio is nothing but factory cost divided by average stock of work in progress. So factory cost, what is factory cost? Prime cost plus all the factory overheads, that is called factory cost. You would have studied this in cost accounting. That is prime cost plus production overhead or the factory overhead, you will get factory cost. And average work in progress is nothing but average stock of work in progress, opening stock of work in progress plus closing stock of work in progress divided by 2, that is average stock of work in progress. So work in progress turnover ratio is equal to factory cost divided by average stock of work in progress. And next is finished good turnover ratio. Finished good turnover ratio is nothing but cost of production or cost of goods sold. If cost of goods sold is given, then you can use cost of goods sold. If cost of goods sold is not given, then you can use cost of production. So inventory turnover ratio or finished goods turnover ratio. The formula is cost of goods sold or cost of production divided by average inventory. Average inventory is nothing but opening stock plus closing stock divided by 2. Okay. So what is this cost of goods sold? Cost of goods sold is nothing but sales minus profit. That is net sales minus gross profit. That is cost of goods sold. Or cost of goods sold can also be calculated using opening stock plus cost of production minus closing stock of finished goods. That is called cost of goods sold. And average inventory is opening stock of finished goods divided plus closing stock of finished goods divided by 2. So these formulas you should remember. How to remember is you should revise it every now and then. Like just write it down all the formulas in the paper and stick in the wall. Whenever you see it, you will just like keep revising it every day for at least 1 month, so that you'll like see this ratios is going to follow you till your group 4. Okay, this ratios till cost and management audit paper. In the final you will be studying these ratios, whereas in final these ratios are very important, like nearly some 30 to 40 marks these ratios, from these ratios itself. So it's better to remember all the ratios now itself, start revising it every day, so that it will be helpful. So how to remember is just write it down, write all the formulas, what are the different ratios, and stick it in the wall and see it every day, and just memorize it. It will be helpful. And finished good, next year we will move on to finished goods turnover ratio. Already we finished finished good turnover ratio, that is cost of goods sold divided by average inventory. And next is debtor turnover ratio. See, debtor turnover ratio, basically it informs us the how speed we are recovering the debts. Okay, seeing debtor turnover ratio, what we can understand is, suppose debtor turnover ratio is very low, then your collection ability of collecting the debts is very bad. Suppose it is very high, then you have speedy recovery, that is speed collection of credit sales of an entity. So debtor turnover ratio can be calculated using credit sales divided by average accounts receivable. Average accounts receivable is nothing but opening debtors plus closing debtors divided by 2. Okay, opening debtors and receivables plus closing debtors and receivables divided by 2, that is called average accounts receivable. So debtor turnover ratio, credit sales divided by average accounts receivable, whereas creditors turnover ratio, credit purchase divided by average accounts payable. That's all. That is the difference between debtor and creditor turnover ratio. And creditor turnover ratio is nothing but it explains the how speedy you are making payment to the creditors. So credit purchase divided by average accounts payable. Credit purchase, you know what is credit purchase? That is creditors plus bills payable. And average accounts payable is nothing but opening accounts payable plus closing accounts payable divided by 2. Credit purchase divided by average accounts payable. And next is working capital turnover ratio. This working capital turnover ratio is very important. This working capital turnover ratio, they will ask you after, like what they'll do is they will give you question, that is they will give you a question to calculate the working capital requirement, and below that they will mention and also find working capital turnover ratio. So that time what you should do is, first you should calculate working capital requirement using that working capital management. Current assets minus current liabilities, you will get net working capital. And after finding that net working capital, you should calculate this working capital turnover ratio. The formula for working capital turnover ratio is net sales divided by working capital. Net sales divided by working capital. And fixed asset turnover ratio can be found using net sales divided by net fixed assets. Simple. You are comparing all the different items with sales, that is net sales. And if it is creditors, it is credit purchase. If it is debtors, with credit sales. If it is finished goods, with cost of goods sold. If it is work in progress, with the factory cost. And if it is raw material, with the cost of raw material consumed. So you are calculating turnovers using the sales, cost of goods sold, credit sales, credit purchase, and cost of raw material consumed. All these are different items which are available in the income statement. Using that, we are calculating the turnover ratios. And last one is capital turnover ratio. Capital turnover ratio is nothing but net sales divided by capital employed. So this capital employed is nothing but debt plus equity. How much is the capital employed? You can either go it in the liability side, that is debt plus equity, or you can go from the asset side, that is fixed assets plus current assets minus current liabilities. That is also capital employed. So holding period calculations. Inventory holding period is, see, after calculating the turnover ratios, they will ask you to calculate holding period. So holding period can be calculated using this four formulas. That is, inventory holding period can be calculated using 365 divided by inventory turnover ratio. What is inventory turnover ratio? Stock of goods sold divided by average inventory. That is inventory turnover ratio. Cost of goods sold divided by inventory turnover ratio. Cost of goods sold divided by average inventory. That is called inventory turnover ratio. And inventory holding period is 365 divided by ITR. Whatever they are asking, whether they are asking inventory or if they are asking debtor or they are asking creditor or working capital, what you should do is 365 divided by the turnover ratio of that particular thing. Suppose debtors, they are asking what is the average collection period of debtors, 365 divided by debtor turnover ratio. If they are asking for creditors holding period, 365 divided by creditors turnover ratio. So that is called holding period calculations. With this, we have completed turnover ratios. Now moving on to overall return ratio. That is the final part of this ratio analysis. Overall return ratios. What is this overall return ratios? That is, what are the different returns which we are getting from the investments? Okay. What is meant by return? Some people, like, seriously, till BCom we were thinking return, filing return is like, okay, right now if I tell you that example, it will be too funny. No one. What is this overall return ratio? Overall return ratio is like comparing your profits with your investments. That is called return ratios. So what is the returns which you are getting from the investment, or returns you are getting from the equity, returns you are getting from the assets, and what are the returns per share, and what are the dividends per share, and what are the price earning ratios, dividend yield ratio, book value per share, market value to the book value. All these are return ratios, overall return ratios. So one by one we'll see. Return on investment. What is this return on investment? What are the total investment? What is the total investment you made, and what is the total profits you receive? If you compare this both, you will get return on investment. So EBIT divided by equity plus debt. That is called return on investment. On the other hand, you can also calculate using PAT plus interest. From this PAT plus interest, you have deducted tax element. So after tax, profit after tax plus interest divided by, see, simple man, how to calculate this return on investment. For equity, you will be paying this profit after tax. That is, whatever the profit after tax is available, that is paid out to equity shareholders. That is, for equity, the profit element is PAT, and for debt, the profit element is interest, because you are making interest payment as the profit to the debenture holders. So what are the profits that should come in numerator? Profit after tax plus interest divided by equity plus debt. That is return on investment. And return on equity, it can be calculated either profit before tax or profit after tax. So profit after tax divided by equity. You should, if suppose tax element is given, you should always go with profit after tax. So profit after tax divided by equity is the return on equity. And return on assets, profit after tax divided by average total assets. So what is this average total assets? Opening total assets plus total closing total assets divided by 2. That is average total assets. So return on assets is profit after tax divided by average total assets. Next is earnings per share. Earnings per share is nothing but earnings available to equity shareholders. That is, first EBIT. From that earnings before interest and tax, you will make payment of interest. Then you will get EBT. That is, after making interest payment, you will get earnings before tax. Then you will make payment to tax. Then you will get, after payment of tax, you will be remaining is profit after tax. From that profit after tax minus, you will make payment to the preference dividend. So after making that preference dividend, the profit left over is profit available to equity shareholders. PAT minus preference dividend is profit available to equity shareholders, or earnings available to equity shareholders. That is the total earnings that is going to be distributed to the equity shareholders. So earnings per share is equal to earnings available to equity shareholders. That is, PAT minus preference dividend is the earnings available to equity shareholders divided by number of equity shares. Below they have given the formula. C. Earnings available to equity shareholders is PAT minus preference dividend. PAT minus preference dividend. That is called earnings available to equity shareholders. Earnings available to equity shareholders divided by number of equity shares is the earnings per share. And dividend per share is total equity dividend divided by number of equity shares. Whatever the equity dividend, total equity dividend which you are making, which you are distributing, that divided by number of equity shares, you will get dividend per share. And price earning ratio. Price earning ratio is nothing but market value per share divided by earnings per share. That is PE ratio. This will follow you till your final. PE ratio is nothing but market price per share divided by earnings per share. Simple way to remember this: MPS divided by EPS. Market value per share. What is your share in the market value? That is, if suppose your book value is 10, your market value is 100, then market value per share is 100. And earnings per share you can be calculated using this earnings per share formula. So MPS divided by EPS is the price earning ratio. Price denotes market price per share. Earnings denotes earnings per share. So in formula itself, you have the what is the formula for this particular price earning ratio? Price earning ratio. Price will come in numerator, earnings will come in denominator. So price means market price per share divided by earnings per share. You will get price earning ratio. And one more thing is, reciprocal of this price earning ratio is the return on investment. Because reciprocal of this price 1 by price earning ratio is nothing but earnings per share divided by market value per share, which means return on investment. What is the return formula? Whatever the earnings distributed, that is earnings divided by investment, that is earnings divided by market value, you will get return on investment. That is called earnings divided by market value. So 1 by PE ratio is nothing but return on investment. And next is dividend yield ratio. Dividend yield ratio is nothing but dividend per share divided by market value per share. Dividend. So dividend will go to numerator. The formula name is dividend yield ratio. So dividend will go to numerator divided by market value per share into 100. Then book value per share. Book value per share is total net worth divided by number of equity shares. Total net worth is fixed assets plus current assets minus current liabilities. That is capital employed. So it can also be called as net worth. So total net worth divided by number of equity shares. And market value to book value ratio is nothing but market price per share divided by book value per share. So these are the different return ratios. When they ask you, normally they won't ask you to calculate return ratio. Like they won't give like this, calculate all the return ratios. This is not going to be the question in exams. They will mention particular ratios like calculate dividend per share, then calculate price earning ratio. Normally these 4 are one set. That is price earning ratio, dividend yield ratio, book value per share, market value to book value ratio. All these 4 are one formula, like one set of formula, which will be asked in exam for 4 marks or 8 marks. So with this, we have completed the theory part of ratio analysis. So what you should do from your side is, after completing this problematics, once we are done with this problematics, you should take down all these formulas in a particular paper and stick it in the room and revise it at least for a month. Because in this inter also, there is sure short question from this ratio analysis. Pakka there will be 12 mark, at least for 12 mark from this ratio analysis, including this MCQs, everything. You'll get around 12 marks from this ratio analysis out of 50 marks for financial management, which is nearly 24%. So ratio analysis is very important chapter. So after finishing these numericals, just take down the formulas, memorize it, keep it in your head, go and write it in your exam. And don't forget it after your exams also. It is required in the finals too. So with this, we have completed the theory part. So now moving on to problematics of this ratio analysis. So there are 10 problems in this ratio analysis. We'll see one by one. Problem number 2. We'll start off with problem number 2. Take your notes, just write it down. First, see the material. Question. Problem number 2. A company has a profit margin of 20%. What is this profit margin? Gross profit ratio. That is, a company has a net profit, or we can assume it anything, profit margin, net profit margin of 20%. So net profit ratio is 20%. And asset turnover of 3 times. What is this asset turnover? Net sales divided by average total assets. So net profit ratio is 20%, asset turnover ratio is 3 times. What is the company's return on investment? How will this return on investment vary if profit margin is increased by 5%, asset turnover is decreased by 2 times, and profit margin is decreased by 5% and asset turnover is increased to 4 times. So now you should understand one thing, that is they have given two formulas, two ratios, that is net profit ratio 20%. What is the formula for net profit ratio? Net profit divided by sales into 100. So net profit divided by sales into 100 is equal to 20%. And asset turnover ratio is 3 times. What is the formula for asset turnover ratio? Net sales divided by total assets. So net sales divided by total assets is 3 times. Net profit divided by total sales, net sales is equal to 20%. So they are asking us two things they have given. One is net profit, that is net profit divided by sales, and next is asset turnover, that is sales divided by total assets. So what they have asked is, what is the company's return on investment? So basically, what is the formula for return on investment? Return on investment is nothing but net profit divided by total investment. There are two ways in calculating total investment. One is calculating the total amount invested by on the liability side by equity plus debt plus current equity plus debt, that is the investment. Or on the other side, by calculating the total assets, we can find that what is the in total investment. So total asset is equal to total investment, which we know total assets is equal to total investment. And what is the return on investment formula? Profit divided by total assets or total investment. So profit divided by total investment we need. So by multiplying this both the formulas, that is net profit ratio, net profit divided by sales, asset turnover ratio, sales divided by total assets. When you cancel both, that is sales and sales, when you multiply net profit into asset turnover ratio, you will get return on investment. See, net profit ratio formula is net profit divided by sales. Asset turnover ratio, sales divided by total assets. When you cancel both the sales, numerator and denominator, that is net profit divided by total assets, which is called return on investment. What is the formula for return on investment? Total net profit divided by total assets, which is called return on investment. So when you multiply both net profit ratio and the asset turnover ratio, you will end up getting return on investment. Simple. They are multiplying two formulas, that is net profit ratio and asset turnover ratio, in order to get return on investment. The formula for net profit ratio is net profit divided by net sales, and asset turnover ratio is equal to net sales divided by total assets. With where if you cancel both the numerator and denominator sales, you will get net profit divided by total assets, which means return on investment. Net profit divided by total assets is called return on investment formula. So here in problem number 2, first they are asking what is the company's return on investment if profit margin is 20%, asset turnover is 3 times. So now put the heading. Problem number 2. First, chapter number 3, ratio analysis. Chapter number 3, ratio analysis. First, problem number 2. Problem number 2. Problem number 2. Small room number 1. Small room number 1. Return on investment is equal to return on investment is equal to net profit ratio into asset turnover ratio. This is the formula. Net profit ratio into asset turnover ratio. So what is the net profit? Below that, write it down. Below that, net profit. What is the formula for net profit ratio? So below that is equal to net profit divided by sales. Net profit divided by sales into sales divided by total assets. Here is equal to net profit divided by sales into sales divided by total assets. Net profit divided by sales into sales divided by total assets. Now cancel both the sales. Sales, numerator sales and denominator sales. to cancel both, you will get is equal to, what is the net profit percentage? 20% into asset turnover ratio is nothing but 3. So is equal to 60%. The net profit ratio which we found is 20%. In the question itself they have given. So asset turnover ratio is 3 times. So return on investment is equal to net profit ratio into asset turnover ratio. So is equal to 20 into 3 is equal to 60%. With that we have found what is return on investment. So after that what they have given is how will this return on investment vary if profit margin is increased by 5%. So now presently profit margin is 20%. If it is increased by 5%, what is the profit margin? Revised profit margin 25%. So 25% into 3 is the revised return on investment. So below that small Roman number 2. Below that small Roman number 2, revised return on investment percentage is equal to, revised return on investment percentage is equal to, revised return on investment percentage is equal to revised net profit ratio, revised net profit ratio into asset turnover ratio, into asset turnover ratio, revised net profit ratio into asset turnover ratio is equal to, what is the revised net profit ratio? 20 plus increase in profit margin is 5. So 25. So 25 into 3 is equal to 75%. So asset turnover ratio is 3 times. Revised net profit ratio is 25. So if you multiply both, answer is 75%. So revised return on investment is equal to 75%. So now see point number 2. How will the return on investment vary if asset turnover is decreased to 2 times? Profit margin is remaining as 20%, whereas asset turnover is reduced to 2 times. What is the return on investment? So below that put small Roman number 3. Small Roman number 3. Revised return on investment is equal to, revised return on investment is equal to net profit ratio into revised asset turnover ratio into revised ATR, that is asset turnover ratio. What is the net profit ratio given in the question? 20%. What is the revised turnover ratio, asset turnover ratio? 2 times. So is equal to 20 into 2 is equal to 20 into 2 is equal to 40%. Is equal to 40%. So revised return on investment is equal to 40%. So coming to the last point, that is profit margin is decreased by 5% and asset turnover is increased to 4 times. Both the ratios are being revised. So profit margin is decreased by 5%, that is 15%. 20 minus 5 is 15%, and asset turnover is increased to 4 times. So now we can find what is the revised return on investment. So below that small Roman number 4. Below that small Roman number 4. Revised return on investment is equal to, revised return on investment is equal to revised net profit ratio, revised net profit ratio into revised and asset turnover ratio into revised ATR. So below that, what is revised net profit ratio? 20 minus 5, that is equal to 15 into asset turnover ratio is 4. So 15 into 4 is equal to 60%. 15 into 4 is equal to 16%. So revised return on investment is 60%. So with this, we have completed problem number 2. Simple man, return on investment formula is net profit divided by total assets. Okay, net profit divided by total assets is the formula for return on investment. So we can find it using net profit ratio into asset turnover ratio, because net profit divided by sales into sales divided by total assets, which will result in net profit divided by total assets only. So return on investment is equal to net profit ratio into asset turnover ratio. So this we have completed problem number 2. So moving on to Problem number 9. Moving on to problem number 9. First we'll read the question. See, why we are reading the question, then we are moving on to solution is, when you read the question and when you understand the concept, then you start the answer, you will be going with the flow. If you read one line and if you start doing an answer and read next line, if you go with the one answer, then you won't know what the adjustment they have given. So always finish the question, entire question, even if you know the answer, even if the same question has been repeated from the material they have asked in exam, just finish reading the question at least twice, then start your answer. It actually works. Okay, next is problem number 9. M Limited had made plans for next year 2015-16. It is estimated that the company will employ total assets of 25 lakhs. So total assets is 25 lakhs. 30% of the assets being financed by debt at an interest cost of 9% per annum. Total assets is 25 lakhs. So out of this 25 lakhs, 30% of the assets is being financed by debt. So the debt to interest cost is 9%. 9% debt they are getting. So 25 lakhs into 30%, which is 7,50,000 is taken as debt at the rate of 9% per annum. The direct cost for the year estimated at 15 lakhs. So the direct cost which is going to be expended for producing the product is 15 lakhs. And all other operating expenses are estimated at 2,40,000. The sales revenue are estimated at 22,50,000. See, the sales revenue is 22,50,000. Direct cost is 15 lakh. And operating expense, other operating expenses 2,40,000. And tax rate is assumed to be 40%. So with this, you are required to calculate net profit margin, which means net profit divided by sales into 100. Return on assets. What is return on assets? Either you can go with PAT or PBT. So PAT divided by total assets into 100. Asset turnover ratio. What is the formula for asset turnover ratio? Net sales divided by average assets or total assets. Here there is no opening and closing assets, so we will go with total assets. And return on equity. Return on equity can be calculated by profit after tax divided by equity. Okay, so this is the problem number 9 question. And now we will move on to solution. See what they have asked is, they have asked one formula from one different category of ratios. Net profit margin belongs to profitability ratios. Return on assets belongs to return ratios. Asset turnover belongs to turnover ratios. Return on equity again belongs to turnover ratio. Return ratios. So 4 ratios they have asked you. So what are the requirements for these 4 ratios that you should find first in order to find the ratios? See, simple. For net profit, what are the requirements? Net profit and sales. Return on assets, what are the requirements? What is profit after tax and total assets? For asset turnover, what is the requirements? Total assets and sales. And return on equity, what is the requirement? Profit after tax and equity. So these are the different requirements for calculating 4 formulas, 4 ratios. So all these requirements you should find. So whenever you get a question, a simple tip is net profit margin. Just next to it, write down net profit divided by sales into 100, so that you will know what are the requirements. All 8 requirements you will remember, so that while calculating the working notes, you will just calculate all the 8 required numbers, so that you can calculate the ratios very easily. That is an easy way of doing working notes. Okay, then we'll move on to solution. Now put the heading. Problem number 9. Problem number 9. Statement number 1. Statement number 1. Operating income statement. Operating income statement. Operating income statement. Below that, 3 column table. First column particulars. First column particulars. Second column amount. Third column also amount. Particulars, amount and amount. Below that particulars, small a. Below the particulars, small a. Sales revenue. Sales revenue. What is the sales revenue they have given? 22,50,000. So outer one column put 22,50,000. Outer one column 22,50,000. Below that small b. Below that small b, total cost. Small b, total cost. Underline it. Below that first arrow mark. What are the different costs they have given here? Direct cost. So below that first arrow mark, direct cost. Direct cost. How much is the direct cost they have given? 15 lakhs. So inner amount column put 15 lakhs. Inner amount column put 15 lakhs. Below that second arrow mark, what is the next cost they have given? Other operating expenses estimated at 2 lakh 40. So second arrow mark, operating expenses. Second arrow mark, operating expenses. So inner amount column 2 lakh 40,000. 2 lakh 40,000. So now inner amount column total it. Inner amount column total it. Outer amount column put 17 lakh 40,000 within bracket. Inner amount column now total it. Outer amount column put 17 lakh 40,000. 17 lakh 40,000 within bracket. Now total it. 22 lakh 50,000 minus 17 lakh 40,000. 22 lakh 50,000 minus 17 lakh 40,000. What is it? Below that, underline it, 5 lakh 10,000. Outer amount column total it 5 lakh 10,000. In respect of that 5 lakh 10,000, small c EBIT. Small c EBIT. Within bracket small a minus small b. What is this EBIT? Earnings before interest and tax. EBIT within bracket small a minus small b. Small a minus small b. Below that, small Roman number, small word d. What is this d? Interest on debt. Once EBIT has been calculated, the next payment which you are going to make is interest payment. That is interest on all the capital that has been brought in as debt. So here total debentures, that is total debt amount is 30% of total assets. So below that D, interest on debt. Below that EBIT put D, small d, interest on debt. Below that open a small bracket. Below that interest on debt, open a small bracket. What is the total assets? 25 lakhs. So open a small bracket, 25 lakhs into 30% into interest cost of 9%. So 25 lakhs into 30% into 9%. Close the bracket. 25 lakh into 30% into 9%. Now close the bracket. Calculate it. Outer amount column put 67,500 within bracket. Outer amount column put 67,500 within bracket. So now total it. Outer amount column total it. 5,10,000 minus 67,500. 5,10,000 minus 67,500. Outer amount column put 4,42,500. 4,42,500. In respect of that 4,42,500, small e profit before tax. Small e profit before tax. Within bracket small c minus small d. Profit before tax. Small c minus small d. So we have calculated profit before tax. Now next is we should calculate what is the tax that is to be paid. So below that small e put small f. Below that profit before tax put small f less tax at the rate of 40%. Here they have given tax rate at 40%. So small f less tax at 40%. Tax at 40%. Below that within bracket, how much is the profit before tax? 4,42,500. So 4 lakh within bracket 4,42,500 into 40%. Whatever the profit before tax value on that 40% should be calculated as tax. 4,42,500 into 40% within bracket. Outer amount column put within bracket 1,77,000. 1,77,000 within bracket. Now outer amount column total it 4,42,500 minus 1,77,000. Outer amount column total it 2,65,500. 2,65,500. In respect of the 2,65,000 profit after tax. What is profit before tax minus tax rate? You will get profit after tax. So in respect of the 2,65,500, small g profit after tax. Small g profit after tax. So now we have calculated what is profit after tax and what is profit before tax. Profit after tax is 2,65,500. Now below that, statement number 2. Statement number 2. Statement showing determination of capital structure. Statement showing determination of capital structure. See, what is the capital structure? Total capital, total assets is the total capital. See, total assets is 25 lakhs, whereas total capital is also 25 lakhs. So out of this 25 lakhs, 30% is financed by debt, which is 7,50,000. Then remaining is equity, right? So 30% 7,50,000. Remaining 70% is 17,50,000, which is equity. So statement number 2, statement showing determination of capital structure. Below the two columnar table. Below the two columnar table, first column particulars, second column amount. First column particulars, second column amount. Below that particulars, small a, long-term debt. Long-term debt. Long-term debt within bracket. How much is the long-term debt? 25 lakhs into 30%. Within bracket 25 lakhs into 30%. Amount column put 7,50,000. Amount column put 7,50,000. Below that small b. Below that small b, equity. Equity within bracket. If suppose 30% is debt, remaining 70% is equity. Okay. Now within bracket 25 lakhs into 70%. 25 lakh into 70%, which is in amount column put 17,50,000. 17,50,000. Now outer amount column, now amount column totally 7,50,000 plus 17,50,000 is 25 lakhs. 7,50,000 plus 17,50,000 is 25 lakhs. In respect of the 25 lakhs, small c, capital employed. Small c, capital employed within bracket a plus b. So see, capital employed and total assets are same because your total assets they have given 25 lakhs and 30% of these assets is financed by debt. Then which means that total capital is 25 lakhs and 30% is debt, remaining 70% is equity. So using that we found what is long-term debt and what is equity. Debt is 7,50,000, equity is 17,50,000. Now coming to the important segment, that is calculation of ratios. Statement number 3. Statement number 3, calculation of ratios. Calculation of ratios. Below that small a, what is the first ratio which they have asked? Net profit margin. That is net profit ratio they have asked. So small a, net profit ratio. Small a, net profit ratio is equal to net profit divided by net sales into 100. Net profit divided by net sales into 100. So formula is net profit divided by net sales into 100. So what is net profit? Net profit is 2,65,500. That is PAT is the net profit, profit after tax. So net profit is 2,65,500. So 2,65,500 divided by what is the net sales we have given 22,50,000. So 2,65,500 divided by 22,50,000 into 100. 2,65,500 divided by 22,50,000 into 100 is equal to, what is the answer? 11.8%. All these profitability ratios should be mentioned with percentage. That is, profitability ratios are calculated on the basis of percentage. So 2,65,500 divided by 22,50,000 into 100 is equal to 11.8%. 11.8%. Here in net profit, instead of taking PAT, you can even take EBIT. That is 5,10,000. 5,10,000. But If you take like that, you should give an assumption that EBIT is taken as net profit. But mostly, if you have PAT, that is profit after tax, always go with profit after tax as net profit. Profit after tax as net profit. Okay, with that first formula over, first ratio is over. Next, below that put small b. Small b. What they have asked, small b, return on assets. Small b, return on assets slash capital employed. Assets and capital employed are same. So return on assets slash capital employed. What is the formula for return on assets? What is the profit after tax plus interest into 1 minus tax rate divided by what is the capital employed, that is debt plus equity. Total assets. You can even take profit after tax plus interest into 1 minus tax rate divided by total assets into 100, or profit after tax plus interest into 1 minus tax rate divided by debt plus equity into 100. Because here capital employed and assets are same. So take down the formula. Return on assets slash capital employed is equal to PAT, that is profit after tax, plus interest into 1 minus tax rate, plus interest into 1 within bracket 1 minus tax rate divided by debt plus equity, divided by debt plus equity into 100. So formula for return on assets is profit after tax plus interest into 1 minus tax rate divided by debt plus equity into 100. So now take the numbers. What is the profit after tax? 2,65,500. 2,65,500. What is the interest which we calculated? 67,500. So interest amount is 67,500. 2,65,500 plus 67,500. Open a bracket. 1 minus, what is the tax rate? 40%. So 1 minus 0.4 or 40%. 1 minus 0.4. Now close the bracket. Divided by what is the debt plus equity which we found? 25 lakhs. So divided by 25 lakhs into 100. Now use the calculator. What is the return on assets? 2,65,500 plus 67,500 into 1.6, that is 1 minus 0.4 divided by 25 lakhs into 100, which is below that is equal to 12.24%. 12.24%. Here, instead of taking profit after tax, we can even take EBIT. That is EBIT into 1 minus tax rate into divided by debt plus equity into 100. EBIT into 1 minus tax rate divided by debt plus equity into 100. Even this formula is acceptable, or profit after tax plus interest within bracket 1 minus tax rate divided by debt plus equity into 100. Both are acceptable. Here, why we are deducting 1 minus tax rate? That you should understand. Because on interest amount, you are getting tax benefits. Because, see, I'll explain you with example itself. See, your total EBIT is 5,10,000. Out of that 5,10,000, you are making interest on debt of 67,500. After making that payment, the amount which is eligible for taxation is only 4,42,500, which means on this 67,500, you are saving some tax, because you are calculating this 40% only on this 4,42,500. Suppose there is no interest on debt. Suppose you didn't get any debt, everything is every capital is been acquired through equity. Then this interest on debt will be nil. Then 5,10,000 will be the profit before tax. Then you will be calculating this tax rate at the rate of 40% at 5,10,000. You won't be calculating at 4,42,500. So on this interest amount, when you are making payment, you are saving some tax benefit. So you are getting some tax benefit that you should reduce it while calculating the return on asset. That is, normally when you are calculating any profit, including the interest, then profit after tax plus interest into 1 minus tax rate. Always it is interest into 1 minus tax rate. Only that amount is profit. Interest into 1 minus tax rate. So that is return on assets and capital employed. The next is asset turnover ratio. So what is the formula for asset turnover ratio? Net sales divided by total assets. Here what is the net sales? 22,000, 22 lakh 50,000. Total assets 25 lakhs. So that is the asset turnover ratio formula. So take down below that small c. Below that small c, asset turnover ratio. Asset turnover ratio ATR is equal to net sales divided by total assets. Net sales divided by total assets. What is net sales? 22 lakh 50,000. Below that is equal to 22 lakh 50,000. 22 lakh 50,000 divided by 25 lakhs. Divided by 25 lakhs is equal to, now calculate using calculator, calculate 22 lakh 50,000 divided by 25 lakhs. What is the amount? 0.9 times. Always turnover ratio should be mentioned in times. All the debtor turnover ratio, creditor turnover ratio, inventory turnover ratio, work in progress turnover ratio, raw material turnover ratio, all these turnover ratios always should be mentioned in times. So what is asset turnover ratio? 0.9 times. So below that, last formula which they are asking is return on equity. For return on equity, you should always take profit after tax. Okay, that because only profit after tax is available for equity. Remaining all, like EBIT is available for interest payment, and EBT is available for taxation purpose, and PAT is available for equity. So here small d, below that put small d, return on equity. Return on equity is equal to PAT divided by equity, that is profit after tax divided by equity. Profit after tax divided by equity into 100 is equal to, what is profit after tax? 2,65,500. 2,65,500 divided by, what is equity? 17,50,000. 17,50,000 into 100. Below that is equal to 15.17 percentage. 15.17 percentage. So that is return on equity. So return on equity should always be calculated using profit after tax divided by equity. And asset turnover ratio is net sales divided by total assets. And return on assets or capital employed is profit after tax plus interest into 1 minus tax rate divided by debt plus equity into 100. And net profit ratio is net profit divided by sales into 100. So these are the 4 formulas which we worked out, 4 ratios. So with this we have completed problem number 9. Now moving on to next problem, that is problem number 3. See what they have given. They have given a balance sheet, and below that they have asked us to find out, you are required to calculate short-term solvency ratios and long-term solvency ratios. Okay. What is this short-term solvency ratios? Short-term solvency ratios is nothing but liquidity ratios. Short-term solvency, you should always remember, short-term solvency means all the liquidity ratios. Long-term solvency means all those capital structure ratios. That is long-term solvency ratios. Now, you see problem number 3. The following is the balance sheet of Y Enterprise for the year ended 31st/12/2015. That is 31st December 2015. Balance sheet as on 31st December 2015. They have given on the liability side and asset side. Liability side, equity share capital, preference share capital, debentures, public debts, bank overdraft, creditors, outstanding creditors, proposed dividends, reserves, provision for taxation, profit and loss account. On the asset side, cash in hand, cash in bank, bills receivable, investments, debtors, stock, furniture, machinery, land and building, goodwill. See, goodwill they have given and preliminary expenses they have given. Okay. During the year, provision for taxation was 20,000. During the year, provision for taxation was 20,000. Dividend was proposed at 10,000. So in the current year, provision for taxation is 20,000 and dividend proposed is 10,000. So profit carried forward from the last year was 15,000. You are required to calculate short-term solvency ratios and long-term solvency ratios. Very simple question, but they will ask this for minimum 8 marks. Minimum 8 marks to 12 marks. Maximum they'll ask this sum for 12 marks. But confirm 8 marks. So 8 marks, you should at least give 6 to 8 formulas, that is ratios. So 1 minute. So what is this short-term solvency ratios? Short-term solvency ratios are liquid ratios, that is current ratio, quick ratio, which means liquid ratio. Next is quick assets ratio, that is uh, current ratio we can find using current assets minus current liabilities. Then quick ratio we can find using quick assets by quick liabilities. And next one is interest coverage ratio. Yeah, interest coverage ratio we can find using EBIT divided by interest. So these are the different ratios, that is short-term solvency ratios. So basically the short-term solvency ratios are current ratio, that is liquid ratio, quick assets ratio, then cash ratio, that is uh, cash interval ratio. But apart from this, whenever they ask short-term solvency ratios, you should also calculate interest coverage ratio, because that is also a short-term solvency. That is interest you are going to make payment every year, that is within 12 months. So interest coverage ratio is also a short-term solvency ratio. So here we are finding three formulas, that is current ratio, quick ratio, and interest coverage ratio. So we'll go one by one. First, solvency. Put the heading problem number 3. Problem number 3, statement number 1. Statement number 1, calculation of short-term solvency ratios. Calculation of short-term solvency ratios. Short-term solvency ratios. Below that, capital A, current ratio. What is the formula for current ratio? Current assets divided by current liabilities. Current ratio is equal to current assets divided by current liabilities. Below that, leave 4 lines gap. Below that, leave 4 lines gap. Note, underline it. What is current assets? Below that, current assets is equal to, what are different current assets they have given? Cash in hand 2000 plus, write it down. Current assets is equal to cash in hand 2000 plus cash in bank 10,000 plus bills receivable 30,000 plus investment. See, investment here we can consider it in two ways. That is, either we can take it as long-term investment or short-term investment. But here we are assuming this as short-term investment because this has been given in the list of, between the list of current assets. That is, cash in bank is current asset, bills receivable is current asset, debtors is current asset, stock is also current asset. So in between this they have given investment. So we are assuming it as short-term investment. Or if you are assuming it as long-term investment, also there is no big deal. You should give an assumption that investment is considered as a long-term investment. So here we are considering it as a short-term investment. So plus 20,000 plus debtors 70,000 plus stock 40,000. So remaining furniture, machinery, land and building, goodwill, preliminary expenses, all these are not current assets. So with this, total it. What is the total current assets? Rupees 1,72,000. Rupees 1,72,000. So current ratio. Now we have found out current assets. So below that, current liabilities. Current liabilities is equal to, what are the current liabilities? Bank order. See, all equity share capital is the equity. 12% preference share capital equity. 16% debentures debt. 18% public debt. Bank OD is a current liability. So under current liabilities is equal to, here we have mentioned the names, whereas in current assets we have mentioned the values. You can do it your way. Like if suppose in exam you are mentioning the names and then you are mentioning the values, it's very nice. Like working notes, how you are presenting your working notes, based on that your marks will be allotted. So you can write the names, that is write the details of current liabilities, then you can calculate the values of current liabilities. It will be helpful. So current liabilities is equal to bank OD plus creditors plus outstanding creditors plus proposed dividends plus provision for taxation plus proposed dividend plus provision for taxation. So if we total it, we are getting 1,37,000. 1,37,000. Just total it. 40,000 plus 60,000 plus 7,000 plus 10,000 plus 20,000, which is 1,37,000. So with this we have found current assets and current liabilities. So now come to the formula. Below that, current assets divided by current liabilities is equal to 1,72,000 divided by 1,37,000. 1,72,000 divided by 1,37,000 is equal to 1.255 is to 1. 1.255 is to 1. So what is the ideal current ratio? 2 is to 1. Here it is 1.255 is to 1. So it is not favorable liquid position. That is, current ratio is not showing a favorable position. But you are in CMA Inter. If you are writing that, it will be an addition. Like evaluator will feel that you know the concepts with the ideal requirements. So it will be a add-on to your like your presentation. The way you present depends on the quality. That is, if suppose ideal ratio you are writing that for every sum you are giving comment, for every assumption you are writing your assumption in separate notes. If separate notes, and then below that itself, below working notes, you are giving your notes as assumptions. These all will give you add-on. This will be an add-on to your presentation. So here we have not written any comment. In Inter, usually we don't write any comment. But if you are giving comment like 2 is to 1 is the ideal ratio, whereas this is 1.255 is to 1. So current ratio is not in a favorable position. It will be good to write that. Okay. With this, we have completed current ratio. Now moving on to quick ratio. Below that current liabilities calculation, put capital B quick ratio. Capital B quick ratio is equal to quick assets divided by quick liabilities. Quick assets divided by quick liabilities. Below that, leave 4 lines gap. Leave 4 lines gap. Notes, underline it. Below that, quick assets is equal to current assets minus inventory minus prepaid expenses. Current assets minus inventory minus prepaid expenses. What is the quick assets formula? Whatever is easily convertible into cash or whatever can be used to make payments. That is quick assets. So current assets minus inventory cannot be used to make payment, and prepaid expenses cannot be used to make payment. You can remember it this way, but the formula is current assets minus inventory minus prepaid expenses. That's all. So below that, what is current assets? 1,72,000 minus what is inventory? Inventory is nothing but stock. That is 40,000. So 1,72,000 minus 40,000 is equal to 1,32,000. Is equal to 1,32,000. So we have found quick assets. Below that, quick liabilities is equal to current liabilities minus bank OD minus cash credit. Bank OD minus cash credit. Bank OD minus cash credit. So below that, what is the current liabilities? 1,37,000. 1,37,000 minus 40,000. Here we have only bank overdraft. We don't have any cash credit. So bank overdraft is 40,000. So 1,37,000 minus 40,000 is equal to 97,000. 97,000. So quick assets is 1,32,000 and quick liabilities is 97,000. Now come to the formula. Below that, quick assets divided by quick liabilities, put is equal to 1,32,000. That is quick assets. 1,32,000 divided by 97,000. Divided by 97,000 is equal to 1.36 is to 1. 1.36 is to 1. 1.36 is to 1. So we have found quick ratio. So now below that quick liabilities, capital C, interest coverage ratio. Interest coverage ratio is equal to EBIT divided by interest. EBIT divided by interest. The concept I have explained you when we were discussing the theory itself. Why the formula is EBIT divided by interest? Once after making payment, after calculating EBIT, next payment which we are going to make is interest. In the leverage analysis, that is in the leverage analysis chapter, when we are calculating the profit after tax, first it will be EBIT, then minus interest, then EBT, then minus tax, we'll get EAT, that is profit after tax. So EBIT, next payment is interest. So interest coverage ratio is nothing but EBIT divided by interest, because how many times of interest is available as your profit to make it while making interest payment, how many times of amount of interest you have as a profit left over for making that interest payment. Suppose my interest is 12,000 and my EBIT is 48,000. That is, using that 48,000, I am going to first make interest payment. So for making 12,000, I have 48,000 in hand. So 48,000 divided by 12,000. That is four times of amount I have, 4 times of interest I have. So the debenture holders will feel safe. That is, the interest coverage ratio is 4 times. So I don't have to worry about my money. So that is why this interest coverage ratio is being calculated. So interest coverage ratio is equal to EBIT divided by interest. Below that, leave 4 lines gap. Note 1. Note 1. Calculation of interest. Calculation of interest. Below the 2 columnar table, particulars and amount. Below the 2 columnar table, particulars and amount. Below that particulars, what are all the different interest payments you are making? You are making interest payment for 12% debentures. You are making interest payment for 18% public debts. These two are interest payments which you are making. So these two are the total interest which you are going to pay for this particular year. So below that particular small a, interest on debentures. Below that particular small a, interest on debentures, open a bracket, 40,000 into 16%. Debentures is 40,000, 16% debentures. So 40,000 into 16%. Amount column put 6,400. Amount column put 6,400. Below that small b, interest on public debt. Interest on public debt. What is the public debt? 20,000 and interest rate is 18%. So below that, open a bracket, 20,000 into 18%. 20,000 into 18%, close the bracket. Amount column put 3,600. Amount column put 3,600. Now amount column total it. 6,400 plus 3,600. Put 10,000. Total it, put 10,000. In respect of that 10,000, put total interest. In respect of that 10,000, total interest. Below that, note number 2, we have calculated interest. Now what we should calculate? EBIT. How can we calculate EBIT? EBIT is nothing but retained earnings plus dividend paid. Plus, what are all? See, 2 ways we can calculate EBIT. Okay, from the top to bottom, when we are coming sales minus total cost of production, we'll get EBIT. Or if we are going from reverse calculation, profit after tax plus whatever the amount has been paid as preference dividend plus whatever the tax you have paid plus whatever the dividend you have paid. All these are ways to calculate EBIT. Reverse working. From top to bottom, if you come, sales minus cost is equal to EBIT minus interest EBT minus tax PAT. Reverse working, PAT plus tax plus interest is equal to EBIT. So that is how we should calculate EBIT. So we'll see, you will understand this with this working note. So note number 2, calculation of EBIT. Below that, 2 columnar table, particulars and amount. 2 columnar table, particulars and amount. Below that particulars, see what is the retained earnings for the current year. See, last year dividend proposed, that is profit and loss account last year is 20,000. Okay, that is end of December 31st, December 2015. At the end of the balance sheet date, that is right now on the balance sheet date, profit and loss account is 20,000. Whereas last year it is 15,000. Profit carried forward from the last year is 15,000. That is on the opening date is 15,000, on the closing date is 20,000. Currently, how much has been transferred to profit and loss account? 5,000. Simple, retained earnings. Retained earnings. Put below particulars, retained earnings. Within bracket 20,000 minus 15,000. 20,000 minus 15,000, that is rupees 5,000. Amount column put 5,000. Simple. 5,000 you have kept as retained earnings in the profit and loss account for the current year. Current year, out of the profits made, you kept 5,000 in the profit and loss account as retained earnings. So 20,000 minus 15,000, that is 5,000. Add dividend paid for the current year. So what is the proposed dividend? Dividend paid for the current year is 10,000. During the year, provision for taxation is 20,000 and dividend was proposed at 10,000. So whatever the retained earnings plus dividend is the profit after tax. Okay, so dividend paid is 10,000. Dividend paid is that is dividend paid only to equity shareholders. Okay, dividend paid for current year is 10,000. That dividend is only for equity shareholders. That is 10,000 is for equity shareholders. So add dividend paid for current year, amount column put 10,000. Now total the amount column 15,000. In respect of that 15,000, earnings available to equity shareholders. Earnings available to equity shareholders. Earnings available to equity shareholders, that is 15,000. Below that, add. See, when you are doing a top to bottom working, after calculating profit after tax, that is profit before tax minus tax, you will get profit after tax. From that profit after tax, first you will deduct preference dividend. If you deduct preference dividend, you will get profit available to equity shareholders. From that, you will deduct dividend paid. Then you will get retained earnings. This is how you calculate top to bottom. Now, when reverse working, retained earnings plus dividend paid, you will get earnings available to equity shareholders. On that, if you add preference dividend, you will get profit after tax. Simple. You are doing a reverse working in order to find the EBIT. That's all. So here, the earnings available to equity shareholders is 15,000. Below that, add preference dividend. Preference dividend. What is the preference dividend paid? See, 1 lakh rupees of preference dividend being raised as a capital at a percentage of 12%. So add preference dividend within bracket 1 lakh into 12%. Within bracket 1 lakh into 12%. So amount column put 12,000. Amount column put 12,000. So 15,000 plus 12,000. Totally 27,000. 15,000 plus 12,000. Totally 27,000. In respect of 27,000, put profit after tax. So we have arrived to profit after tax. In respect of the 27,000, put profit after tax. Below that, see, once profit after tax has been calculated, in reverse working, above profit after tax, what will be there? Tax. So profit after tax plus tax paid, you will get profit before tax. So below that profit after tax, add tax paid for current year. Tax paid for current year. So below in adjustment during the year, provision for taxation was 20,000. So add tax paid for the current year 20,000. 20,000. Now totally 27,000 plus 20,000, you are getting 47,000. 47,000, that is profit before tax. That is profit before tax. So below that profit before tax, once you got EBT, EBT means PBT, profit before tax. On that, if you add interest, it will be PBIT. That is EBIT, earnings before interest and tax. So we got EBT. Now we need EBIT. So you should add interest. So what is interest on debt? What we find as interest on debt? Total interest on debt is 10,000. So we should add interest on debt. Below that profit before tax, add interest on debt. interest on debt, amount column put 10,000. Amount column put 10,000. If you add both, total it 57,000. Therefore, 57,000 in respect of 57,000 EBIT. EBIT, that is earnings before interest and tax. So now you just understand this. Now we will go reverse. EBIT, that is 57,000. Okay. On that we will deduct interest on debt normally. So interest, if we deduct 10,000, we will get profit before tax, that is 47,000. From profit before tax, if we deduct tax paid of 20,000, we will get profit after tax of 27,000. From profit after tax, first we will deduct preference dividend, that is 12,000. Then we will get 15,000, that is profit available to an equity shareholders. From the profit available to equity shareholders, we will deduct dividend paid, that is 10,000, to calculate what is the retained earnings, that is 5,000. Simple reverse working we did in order to find EBIT. So what is interest amount? 10,000. What is EBIT? 57,000. So with this we can calculate interest coverage ratio. Now come to the interest coverage ratio. Formula is EBIT divided by interest. Below that, EBIT divided by interest is equal to 57,000 divided by 10,000. 57,000 divided by 10,000. That is 5.7 is to 1. 5.7 is to 1. 5.7 is to 1. So we calculated all the short-term solvency ratios. Now below that working note, just give comment. Current ratio. Current ratio is lower than the ideal ratio. Current ratio is lower than the ideal ratio. Hence the liquidity position of the entity. Hence the liquidity position of the entity is not satisfactory. Liquidity position of the entity is not satisfactory. And quick ratio is slightly higher than the ideal ratio. What is the ideal ratio for quick ratio? Ideal ratio is 1:1. Whereas here quick ratio, what we found? 1.36:1. So it is more than the ideal ratio. So below that take note. The quick ratio is slightly higher than the ideal ratio. Hence, the absolute liquidity of the entity is satisfactory. This is how you should write a comment. Hence, absolute liquidity of the entity is satisfactory. Now next, what they have asked us to find? Long-term solvency ratios. Below that, statement number 2. Computation of long-term solvency ratios. Computation of long-term solvency ratios. Below that, small a. What is the long-term solvency? Different solvency ratios: debt to equity, debt to total fund, then equity to total fund, proprietary ratio. We can even find proprietary ratio, and one more ratio is, once again, debt to equity, then debt to total fund. Oh my god, here they have calculated only two formulas. You can even calculate equity. Now, that is, they have asked only long-term solvency ratios. They didn't mention what are the different ratios which we find, but we can even find 2 more ratios, that is proprietary ratio and debt to equity to total fund. At least we should mention 3 ratios. That is, if suppose they have asked a balance sheet and they have asked short-term solvency and long-term solvency, 3 short-term solvency and 3 long-term solvency ratios are mandatory. So first, small a, debt to equity ratio. Debt to equity ratio is equal to debt divided by equity. Formula is debt divided by equity. Now we should first find what is debt and what is equity. Below that, leave 4 lines gap. Note number 1. Debt is equal to 12% debentures. 12% debentures. How come it is 12% debentures? It is 16% debentures 16%, sorry, 16% debentures plus 18% public debt. 16%, erase the 12% debentures. This is not 12%, this is 16%. It is 12% preference share capital. Written wrong. Okay, 16% debentures plus 18% public debts. Plus 18% public debts. So is equal to 40,000. What is 12%? 16% debentures 40,000. And what is 18% public debt? 20,000. 40,000 plus 20,000 is equal to 60,000. So total debt is 60,000. Below that, note 2. Below that, note number 2. Equity is equal to equity share capital. Equity share capital plus 12% preference share capital plus 12% preference share capital plus reserves plus profit and loss account minus preliminary expenses. Here I should mention one thing, that is goodwill is 35,000 here. You can even deduct goodwill from this equity. That is like how you detect preliminary expenses, you should detect goodwill also. But some problems they would have detected goodwill, some problems they wouldn't have detected goodwill. So it is your choice. But if you follow detecting goodwill for all the sums. Or if you don't follow detecting goodwill, don't detect goodwill. I'm telling only for this chapter. So now in this equity, if you want to deduct goodwill, minus goodwill, you include the less goodwill also. But in this problem, they didn't detect the goodwill because they went assuming that goodwill not to detect goodwill. But if you want to deduct, you can deduct. In material, they would have given to deduct goodwill. Okay. So below that is equal to, what is equity share capital? 1 lakh plus preference share capital 1 lakh. 1 lakh plus 1 lakh plus 1,50,000 plus 20,000 minus 10,000. Total it is equal to 3,60,000. Is equal to 3,60,000. So debt is 60,000 and equity is 3,60,000. Now coming to the formula, debt divided by equity is equal to 60 divided by 3,60,000. 60 divided by 3,60,000. Below that is equal to 0.7:1. 0.7:1. 0.17:1. Sorry, 0.17:1. 0.17:1. Okay. Now below that, point number B, debt to total fund. Debt to total fund ratio is equal to debt divided by total fund. Debt divided by total fund. This is also a long-term solvency ratio. Debt divided by total fund. So what is it? Below that, leave 2 lines gap. Note number 1. Total fund is equal to debt plus equity. Debt plus equity is equal to 60,000 plus 3,60,000. 60,000 plus 3,60,000 is equal to 4,20,000. 4,20,000. 4,20,000. So that is the total fund. So now come to the formula, debt divided by total fund is equal to, how much is the debt? 60,000. So is equal to 60,000 divided by 4,20,000 is equal to 60,000 divided by 4,20,000. So therefore is equal to 0.14:1. 0.14:1. 0.14:1. Now below that, small c. Equity divided by total fund. Equity divided by total fund. Equity divided by total fund. So below that, what is equity? 3,60,000. 3,60,000 divided by 4,20,000. 3,60,000 divided by 4,20,000. 3,60,000 divided by 4,20,000 is equal to 0.86 is to 1. 0.86 is to 1. 0.86 is to 1. So we have calculated 3 short-term solvency ratios, 3 long-term solvency ratios. Below that, comment. Below that, comment. The long-term solvency position of the company, the long-term solvency position of the company is quite satisfactory. Is quite satisfactory. So with this, we have completed problem number 3. So now, moving on to problem number 4. Moving on to problem number 4. Same question. Same what we did in problem number 3, we are going to do it in problem number 4. They have asked us to test the liquidity and test the solvency. I think so you can do this problem on your own, because there is no change in the question also. Like the pattern of the question is same. They have asked us to test the liquidity and test the solvency. And for the liquidity, we are calculating 3 ratios: current ratio, quick ratio, and interest coverage ratio. And for solvency, we are calculating debt to equity ratio and debt to total fund ratio. Whereas you can add one more ratio, that is debt equity to total fund ratio. So entire thing is same. You can do it on your own. Can you? What we'll do? Okay, we'll just cover off. Put the heading. Problem number 4. First, we'll see the question. Following is the balance sheet of Yes Limited as on December 31st, 2015. They have given equity share capital reserves, 8% loan on mortgage, that is debentures, that is debt, trade creditors, bank overdraft, taxation for the current 2,000 and for future 2,000, profit and loss account, that is profit after tax for the year is 12,000, plus transfer to reserves and dividend 4,000 and 2,000. On the asset side, goodwill, fixed assets, stock, debtors, investment, and cash in hand. So with this, we are going to calculate. Below that, they have given sales amount to 1,20,000. With this, we are going to calculate ratios, that is testing the liquidity and testing the solvency. Put that in problem number 4. Problem number 4. Calculation. Statement number 1. Calculation of liquidity ratios. Calculation of liquidity ratios. Below that, capital A current ratio. Below that, capital A current ratio is equal to current assets divided by current liabilities. Current assets divided by current liabilities. Current assets divided by current liabilities. Below that, leave 4 lines gap. Leave 4 lines gap. Notes. Point number 1. Current assets. Current assets is equal to, what are the different current assets given here? Stock 6,000 plus debtors 6,000 plus investments 2,000 plus cash in hand 6,000 is equal to 6,000 plus 2,000 plus 6,000 plus 6,000 is equal to 20,000. So current assets is equal to 20,000. And point number 2, below that, point number 2, current liabilities is equal to trade creditors 8,000 plus bank overdrafts 2,000 plus taxation for the current, that is tax which has only paid, so 2,000 plus. So 8,000 plus 2,000 plus 2,000 is equal to 12,000. 8,000 plus 2,000 plus 2,000 is equal to 12,000. So now coming to the formula, we have found that current assets is 20,000, current liabilities is 12,000. Now come to the formula, current assets divided by current liabilities. Below that is equal to 20,000 divided by 12,000. 20,000 divided by 12,000 is equal to 1.67 is to 1. 1.67 is to 1. Now, below that, capital B. Below the notes, capital B, quick ratio. Quick ratio is equal to quick assets divided by quick liabilities. Quick assets divided by quick liabilities. Now leave 4 lines gap below that notes. Leave 4 lines gap below that notes. Point number 1. Quick assets is equal to current assets minus inventory minus prepaid expenses. Current assets minus inventory minus prepaid expenses. So what is the current assets which we calculated? 20,000 is equal to 20,000 minus what is the stock, that is inventory, 6,000. So 20,000 minus 6,000 is equal to 14,000. 20,000 minus 6,000 is equal to 14,000. That is quick assets. Below that, point number 2, quick liabilities. Current liabilities minus bank OD minus cash credit. Current liabilities minus bank OD minus cash credit. That is 12,000. What is current liabilities? 12,000 minus what is bank OD which they have given? 2,000 minus what is cash credit? 0. So 12,000 minus 2,000 is equal to 10,000. Quick liabilities is 10,000. Quick assets is 14,000. So come to the formula. Quick assets divided by quick liabilities is equal to 14,000 divided by 10,000. 14,000 divided by 10,000 is below that is equal to 1.4 is to 1. 1.4 is to 1. So we have calculated quick ratio. Now below that, quick liabilities, capital C. Capital C, interest coverage ratio. Interest coverage ratio is also solvency ratio. We saw it in the previous sum itself. So interest coverage ratio is equal to EBIT divided by interest. How much times of interest has been covered by EBIT? That is EBIT divided by interest. So we have to calculate both EBIT and interest. Below that, leave 5 lines gap. Notes. Notes. Point number 1. Interest is equal to, first we should calculate interest. So interest is equal to, what is the interest which has been paid? 16,000 interest loan amount has been taken at 8% interest. So interest is equal to 16,000 into 8%. 16,000 into 8% is equal to 1,218. 1,218. Below that, point number 2. Calculation of EBIT. Calculation of EBIT. Below the 2 columnar table, first column particulars and second column amount. First column particulars and second column amount. Below that particular, see EBIT, what we did in the previous one, same thing we are going to do. We are going to reverse work. Here, nothing has been distributed as preference share capital. So, the whatever the tax which is been profit after tax, on that if we add dividend, we'll get whatever is the leftover amount after paying dividend. From that, if you add dividend, you will get profit after tax. On that, if we add tax, we will get profit before tax. And on that, if we add interest, we will get EBIT. Simple. So here profit after tax given is 12,000. Profit after tax given is 12,000. On the profit after tax, if we add tax paid of 2,000. So below that particulars, profit after tax 12,000. Profit after tax 12,000 plus tax paid for the current year plus tax paid for the current year. Amount column put 2,000. Now totally 12,000 plus 2,000 is 14,000. 14,000. In respect of that 14,000, profit before tax. In respect of that 14,000, profit before tax. Below that profit before tax, add interest. Add interest. How much is the interest paid? 1,280. So add interest, amount column put 1,280. 1,280. Now total the amount column 14,000 plus 1,280. That is 15,280. 15,280. In respect of that 15,280, put EBIT. In respect of that 15,280, put EBIT. So with this we have calculated EBIT. Interest and EBIT both we have calculated. Come to the formula. What is the formula? EBIT divided by interest. Below that is equal to, what is EBIT? 15,280. 15,280 divided by 1,280. 15,280 divided by 1,280 is equal to 11.94 is to 1. 11.94 is to 1. So that is the interest coverage ratio. With this we have calculated all the liquidity ratios. Below that comment. Below that comment. Overall liquidity position of the entity. Overall liquidity position of the entity is satisfactory. Is satisfactory. See, comment is up to your analysis. That is, whatever the report which you want to give based on the analysis which you did, on that you comment. You don't have to remember the comment which we are giving and just write the same comment in the exam. Comment is something like what you analyze on the particular problem, that you should give it as comment. So overall liquidity position of the entity is satisfactory. So next, they have asked testing the solvency. That is, we should calculate long-term solvency ratios. So below that, statement number 2, calculation of solvency ratio. Calculation of solvency ratio. Below that, small a, debt to equity ratio is equal to debt to equity ratio. What are the solvency ratio? Debt to equity, debt to total fund, equity to total fund. These are the 3 common ratios. So small a, debt to equity ratio is equal to debt divided by equity. Debt divided by equity. So what is debt here? Below that, leave 2 lines gap. Notes. Right? Notes. Point number 1. Debt is equal to only one debt is that is 16,000 is equal to 16,000. 8% loan mortgage, that is 16,000 is equal to 16,000. Next, point number 2. Point number 2. Equity is equal to equity share capital, that is 20,000 plus capital reserves, that is 4,000 plus future taxation, that is 2,000 plus. Always future taxation will come into equity. Current taxation will go into payments made. That is, you should deduct it from the EBIT. Excuse me. Okay. Equity 20,000 plus 4,000 plus 2,000 plus what is P&L account balance, that is 6,000 plus 6,000. Now total it is equal to 32,000. Is equal to 32,000. Now we calculated what is debt, that is 16,000 and equity is 32,000. Now come to the formula. Debt divided by equity is equal to 16,000 divided by 32. 16,000 divided by 32,000 is equal to 0.5 is to 1. Is equal to 0.5 is to 1. So below that, small b, debt to total fund. Debt to total fund ratio is equal to debt divided by total fund. Is equal to debt divided by total fund. Below that, leave 1 line gap. Total fund is equal to debt plus equity. Debt plus equity, which is equal to 16,000 plus 32,000. 16,000 plus 32,000 equal to 48,000. So total fund is 48,000. What is total fund? Total fund is a summation of debt plus equity. So 48,000. Now coming to the formula, debt divided by total fund is equal to 16,000 divided by 48,000 16,000 divided by 48,000 is equal to 0.33 is to 1. 0.33 is to 1. Below that, small c, take down small c, equity to total fund ratio. Equity to total fund ratio is equal to equity divided by total fund. Equity divided by total fund. Equity divided by total fund is equal to 16,000. Sorry, equity is 32,000. 32,000 divided by 48,000. 32,000 divided by 48,000 is equal to 0.67 is to 1. 0.67 is to 1. With this, we have completed solvency ratios. Below that, comment. Overall long-term solvency of the entity is satisfactory. Overall long-term solvency of the entity is satisfactory. Okay, now we'll move on to problem number 5. Actually, in the previous problem, that is problem number 4, here they have given sales amount to 1,20,000. This has been given only to confuse you. Okay, in both these liquidity ratios and solvency ratios, there is no sales requirement. For calculating EBIT, sales is required, but if sales they are given, cost must be there to calculate EBIT. Here sales has been given only to confuse you. So this is how they will confuse in exam. For testing liquidity and solvency, you don't need a sales amount itself, but they are given 1,20,000 as an adjustment in order to confuse you. So liquidity means current ratio, liquid ratio. You should remember this. Testing solvency means both debt to equity, debt to total fund, equity to total fund, proprietary ratio. All these are solvency ratios. Okay. With this, we'll move on to problem number 5. With the help of the following information, complete the balance sheet of MNOP Limited. Equity share capital 1 lakh. They are asking us to complete the balance sheet. Okay. What in this sum, what we should do is we should frame a balance sheet using the given formulas. Equity share capital is 1 lakh. The relevant ratios of the companies are as follows. Current debt to total debt 40%. Okay. Current debt to total debt is 40%. Total debt to owner's equity 60%. Total debt to owner's equity is 60%. Fixed assets to owner's equity 60%. Total asset turnover. What is total asset turnover formula? Net sales divided by total assets. So 2 times. Inventory turnover. Inventory turnover is cost of goods sold divided by average stock. Average stock. That is closing stock plus opening stock divided by 2. So this is the different data they have given. With this, we should calculate the balance sheet. Okay. What will come in the balance sheet? Balance sheet liabilities, right? Equity share capital, debts, and current liabilities. Whereas on the asset side, current assets and fixed assets. So these are the different balance. Don't see the balance sheet now. We'll just finish the working notes. Then only we can frame this balance sheet. In this, just put the heading. Problem number 5. Problem. Something happened with this internet issues. So we'll just continue with the problem number 5 in the next video.